All right, in today's video, what I want to talk about is the permanent portfolio. So what is it that I mean when I say a permanent portfolio? This is something where basically, let's say someone has a retirement fund, 500,000, a million, or you're setting up your estate. And let's say you pass on your wealth to your children, how is it that you want it allocated? So this isn't for someone who's looking to day trade or swing trade, or even do like deep research on individual companies and choosing individual stocks. This is for someone basically saying, I have this pile of money, whatever that pile is, and I want to set it and forget it, essentially. And so there are a couple different, there's many options out there, but there's a couple that stand out to me. So I mentioned in a video I did maybe a few weeks ago, one that I've created, and I actually have my mother's annuity in that, and it's done very, very well. It's a 70-10-10-10 portfolio. It's 70% stocks, 10% bonds, 10% real estate, 10% commodities. And the real estate and the commodities are two areas that I feel a lot of investors overlook. I guess just kind of the whole industry started with just stocks and bonds. And so, commodities and real estate are, again, just sort of an afterthought. But I think, with commodities, when you're getting gold and silver, you can really shine during inflationary periods. Not that we've really dealt with that recently, but if it's something, where, the sort of transitory inflation leads to really, I don't want to say hyperinflation. Hopefully that doesn't happen. But if it does, things like real assets, gold, silver, real estate will do well. So that's why I prefer my 70-10-10-10 to others. So let's talk about another one. There's the classic 60-40 stock and bond portfolio. That's a very kind of blue-blooded, old money WASP, New England. Okay, my granddaddy's daddy gave me this, and let's just keep it in that 60-40 portfolio. Also for retirees, I personally feel that's a little bit bond heavy, but that's fine. And then let's take perhaps the greatest investor of all time, Warren Buffett. So the question is, what is Warren Buffett going to do with his wealth when he passes that on to his wife? And so he's allocating it to a 90-10, 90% Vanguard S&P 500, 10% short-term bonds, which is essentially almost a proxy for cash. So he's doing the 90-10. And then recently, I came across a guy on YouTube, great channel. His name is Berger, and he talks about creating a 3 ETF portfolio. And so what I can do here, what I've done is in Composer, which again, I view Composer as a conflation of M1 Finance, Portfolio Visualizer, and Python. Why is that? M1 Finance, you can kind of create pies. Motif used to have it with motifs. So you can actually create some of these in M1. Portfolio Visualizer, you can actually back test it. You can do a lot of back testing in Portfolio Visualizer, which you can do on Composer. And then the Python is basically, if you've built these strategies, ones that are a little bit more than just pies, meaning ones that are more based on logic, if this, then that, you can actually integrate it into brokerage. Right now, they're using Alpaca. So that's why, again, I see it as M1 meets Portfolio Visualizer meets Python. So, but what I was able to do here is I took, let me scroll down a little bit. All right. So I took the 3-fund portfolio created by Berger. Okay. And this is going back, I believe, to 2016. Let's just verify that. Yep. January of 16, okay? And it's compared to SPY. It's also compared to my 70, 10, 10, 10. Now, his three-fund portfolio is 50% total market, so VTI, 30% international stock, I believe that's VXUS, and then 20% bonds. And I think it's a great portfolio, actually. Also, it just, again, I do like owning commodities. I do like owning real estate. But I think that's fine. It's essentially an 80-20 portfolio, meaning 80 stock, 20% bonds. So let's look at it. It's got a 12.6 annualized return. Standard deviation is low. Max drawdown 27.8, CalMAR ratio 0.45. Now, compared to the S&P, 17% max drawdown. So you see the max drawdown of SPY is much lower, but it has a higher CalMAR ratio. So the risk to reward ratio, you have your Sharp, your CalMAR, your Sortino. SPY actually has a higher Sharp ratio also. So now let's compare that against my permanent store of wealth for ETFs. So it's under the S&P, 14.2. Its Sharp ratio is just under SPY. It's above the three fund. It has a higher standard of deviation than the three fund, but less than SPY. And it has a higher max drawdown than the three fund, but lower than SPY. The CalMAR is 0.46, so it's above the three fund, lower than SPY. So just looking at this, my initial thoughts go to people like Jack Bogle and J.L. Collins, The Simple Path to Wealth, and just indexers. So here you have this gentleman, Rob Berger. You have myself creating these funds, creating these sort of permanent stores of wealth, these permanent portfolios. But someone who just bought VOO or SPY has done much better. So that's just that. Again, I just think of Bogle when he says, just keep it simple. Just keep it, very basic. Now, you could argue that being 100% in stock is not a great place to be. We're only going back to 2016, so on and so forth. Your max drawdown is more. But again, someone who's just dollar costing every month into VO or SPY is going to end up ahead of a lot of others who get cute. So what I also did here is I did my 4 ETF with leverage. Okay. So that would mean that the VOO is UPRO. I believe I did TMF for the bond leverage. I think I did UGL for commodities. We can actually pull it up after, but just to show you the power of leverage here, the annualized return is 38.6. So it crushes SPY, permanent store of wealth, and even the 60-40 just beneath it here. But look at its max drawdown, 60%. So let's say you allocated $100,000 into something like this. Well, your 100,000 goes down, let's say, to 40,000. If the max drawdown took place right after you initially put it in. So, that could be daunting and fear-inducing for many people. So, but look at your overall return, and its CalMAR ratio and its Sharp ratio they're both very good. It's 0.64, 1.05. Its Sharp ratio is beneath the traditional 60-40. But still it's over 1, so it's good. Look at the 60-40 versus this leverage one, 38.6, 12.2. So let's also, let's see if we can add one more. Let's see if I can add the Warren Buffett 90-10. So we're going to go to add, and we're going to scroll down here. I think it's probably at the bottom. Yep, Warren Buffett Legacy. There it is. Okay. And there it is. The Warren Buffett Legacy is in blue. And again, the Warren Buffett Legacy is 90% VOO, 10% short-term bonds. I believe it's BSV is the ticker. Again, just on this graph, I mean, just look at the leverage one versus all the others are kind of in the same range. You know, but look here though, look at the leverage. I mean, you were all the way here, and during 2020, March of 2020, you totally crashed. One of my superhuman powers in investing is being able to deal with volatility. So not everyone is built like that. It's like a boxer. Some boxers have a lot of skills, but when they get hit with a big shot, it's called a glass chin. You know, they drop. Other guys, you know, may not be as skilled, but when they get hit with shots, they just keep walking through them, or they just shrug them off. So, you know, I feel that my ability to deal with volatility sets me apart from others. And Buffett said it himself. So just kind of looking at all these, you know, people talk about Sharpe, Sortino, Kalmar, standard deviation. He kind of breaks it down in a very folksy, Forrest Gump kind of way, you know, and he says, I'd rather have a lumpy 15% return than a smooth 12% return. So a lot of times, you know, you can do all this risk parity and Sharpe ratio, Sortino, but you're underperforming someone who's going to have a higher standard deviation, lower Sharpe ratio, lower Kalmar, but at the end of the day, they're going to have more money. And if you can deal with a little bit of volatility, 3 percentage points over 20 or 30 years, depending on your starting point, ends up being hundreds of thousands, if not millions. For those of you who watch my videos, the last video I did, I run over $1 million, and it's about $1,040,000. And I talked about, if I want to get to 100 million at 60, what is it that I need to do with this $1 million? It's 25.7% return. If I were to only get a 16% return, it was going to be 20 million. So the difference between a 16% return and a 25% return is $80 million. So it's massive. Now, we could also pull it up in the difference between a 25 and a 22% return. You know, maybe it's not $80 million, maybe it's still 5 million or 10 million. So, you know, percentages matter. And again, I'll say another truism that I always talk about here is the 1% of investors compound capital in the 20 to 30% range long term. Anyone, perhaps, you know, can do it over a few years, 2 years, 2 years, 3 years, but year 10, year 18, year 25. Again, why is Monish Pabri, I think his license plate is 26% or something like that. You know, that's his aim, because I think he understands that if he compounds at 26%, it's game over. You know, it's hundreds of millions, if not billions. So anyway, let's just take a look at the Warren Buffett now. Let's scroll back down in Composer. And so you can see more of a stock heavy Warren Buffett 90-10 against a 60-40. You know, you're getting that couple percentage point difference, but you're probably gonna have more of a, yep, there it is. You're gonna have more of a max drawdown, and Kalmar ratio 0.51. So again, if you invested in the leverage version of the 70-10-10-10, you're going to end up with the most money, but you're also going to have the biggest max drawdown. For me, I will take a 60% drawdown for a 38.6% return over time versus, you know, a 12% return, and having, you know, only a 27.8% max drawdown. But that's just me. You know, there's other people there that I know, they just can't deal with any drawdowns. They have kind of a working class wage earning mentality. I worked my whole life for this, and no one ever handed me anything. And this is 2 or 3 or 4 years of labor, my job. So, it really bothers them. So again, in Composer, you can really compare and contrast. And I would agree with Rob Berger. He said that M1, if you were starting today, would be the brokerage that he uses. It seems like to be the best one out there of the brokers. I personally can't use it. I would love to use it. I can't use it because I have my money in an LLC. And I learned this from Kim Kiyosaki, Robert Kiyosaki's wife. She went to a seminar and one time, and the gentleman said, "The rich own nothing but control everything." So I have my money in LLCs and such. I don't hold really anything personally. With M1, for some reason, you can't open an LLC account, which is bizarre. With TD Ameritrade, with Interactive Brokers and others, it's a non-issue. Maybe because they're a newer brokerage, and so maybe that's something they'll work on. But yeah, so that's just kind of a cool thing here in Composer. You could actually take this and say, okay, I have this lump of money. I inherited $200,000, or I inherited $2 million, and I don't want to be like checking CNBC and Bloomberg and ticker tapes and reading annual reports and what are my friends, what IPO is coming out, and just kind of being, having your finger on the pulse, so to speak. So you can kind of say, well, what's my best permanent store of wealth? So let's also just, before I go here, let's change the dates. I think it's down here. So let's go 3 years. Let's do 3 years. So now it's going to automatically go to 2018. See that there? August 3rd, 2018. And then maybe we'll just do it over 1 year. So you can kind of go back and say, oh, I'm doing research. Again, this is very, very much like Portfolio Visualizer. The thing with Portfolio Visualizer, you can go a lot further back, I think, than here. But so where are we? Okay, so let's just go on annualized returns. For ETFs, 42. Again, just someone who knows nothing about markets, who just took Bogle's advice, J.L. Collins' advice, even Warren Buffett, buy indexes is number 2. So all this cute stuff of, this percentage to that percentage, it's the highest of the non-leveraged. And then we go to Buffett's one is next at 16.2. And then the Mayan, the 70-10-10-10 is 14.9. And then we have the 60-40. And then we have the 12.8, the 3 fund. And let's go 1 year. So now let's go back here. See, look at the, here's the upside of leverage. Here's the downside of leverage. Look at that. The leverage one went underneath tremendously all the others. You can see in March of 2020. But again, when you're coming out of it, you can see what happens. But let's go 1 year. So this is going to be August 2nd, 2020 to August 2nd, 2021. Let's come down. Wow. So my leveraged version of my 70-10-10-10, 87.7. Wow. That's really, really good. So, and then you have SPY coming in number 2, Warren Buffett's 90-10, number 3. Just behind it is the unleveraged version of 70-10-10-10, then with the 60-40, then with the 3 fund, then the 60-40. So these were actually switched, I think, on the 3 year. So look at the Calmar ratios of all of them. Sharp ratios also, and just this year, all of them are above 2 except for the leverage version. Max drawdowns, again, look how low the non-leverage ones are, 6%, 9%, 8%. And all of a sudden you're down 23.1% here, 5.9, 8.6. But again, your cumulative return, 87%. So Leverage. What is it that Munger says? Liquor, ladies, and leverage can lead to the downfall of many people. So that's it for today. Kind of a longer video, but it just wanted to show with Composer what you can do in order to make informed decisions with your capital. So take care. I'll see you guys soon. Ciao.